You ever try to look up where rich people actually keep their money? Like you can find their business names, maybe some charity work, a few properties listed here and there, but their real wealth, the actual houses, cars, investment accounts, you won't find any of it in their name. Now, you might think they're just being secretive or paranoid, but here's what's actually happening. Putting assets in your own name is like walking around with a giant target on your back. And once you understand why, you'll never look at wealth the same way again. My name is Leo, and today I'm pulling back the curtain on exactly how the wealthy make their money invisible to lawsuits, creditors, and anyone who wants a piece of it. But here's the best part. Some of these strategies aren't just for billionaires. You can use them too. Most people just don't know they exist. Hit that subscribe button if you want to understand how money really works, not just how they tell you it works. And smash the like button if you're ready to learn what the wealthy do that you've never been taught. Let me tell you about someone worth over $800 million. We'll call him David because using his real name defeats the purpose of this entire video. $800 million, documented, verified, real wealth. But if you try to find his assets, you'd find absolutely nothing. His mansion, not in his name. It's owned by a trust, and that trust is managed by another entity that's registered in Delaware. His investment portfolio is spread across multiple LLCs, and none of them show his name on public documents. His business interests are structured through holding companies, and those holding companies are owned by other holding companies. Now, you might be thinking this is some elaborate tax dodge, but here's what you're missing. This is about protection. Because when you're wealthy, you become a target. Therefore, wealthy people separate themselves from their assets, but most people keep everything in their own name. Therefore, most people are completely exposed when something goes wrong. Someone slips at your rental property, they can take everything you own. Car accident, your house is on the line. Business deal goes bad, your savings account gets drained. But when you separate yourself from your assets using legal structures, you create walls that lawsuits can't break through. And that's exactly what we're about to explore. Here's the concept that changes everything. You are not your assets, and your assets should not be tied directly to you. Think about it like this. Imagine carrying a backpack full of cash through a dangerous neighborhood. That's what direct ownership looks like, with everything strapped to your back and vulnerable to anyone who takes a swing. Now imagine having a team carry separate bags while you coordinate from safety. That's proper asset structuring. If someone goes after one bag, the others stay protected. And you're not even holding anything directly. The wealthy understand this completely because legal separation creates practical protection. When assets live in different entities, each entity is its own legal person. Therefore, liability in one area can't touch everything else you own. But here's where most people get this completely wrong. They think this is about hiding money from the government, but it's not. This is intelligent risk management. It's making sure one bad event doesn't wipe out decades of work. Let me make this crystal clear. One lawsuit shouldn't destroy everything you've built. But if you own everything directly, that's exactly what can happen. Therefore, separation isn't optional for serious wealth building. It's mandatory. All right, let's start with something you can actually use right now. The Limited Liability Company, or LLC for short. An LLC is a legal shield between you and your asset. It's its own entity that can own property, run a business, and get sued. But here's the crucial part. When someone sues the LLC, they're suing the LLC, not you personally. Let's make this real. Say you own a rental property in your name, and a tenant sues because they claim the stairs were unsafe. They win. Guess what they can take? Your personal bank accounts, your house, your retirement savings. Everything is on the table. But what if that rental was owned by an LLC? Same lawsuit happens. They sue the LLC, they win. The most they can get is whatever equity exists in that property. Your personal stuff is protected and completely untouchable. Now here's where wealthy people take this to another level entirely. They don't use one LLC, they use multiple LLCs, each holding different assets. This creates what's called compartmentalization. You might have one LLC for California rentals, another for Texas rentals, and another for your online business. Something goes wrong in Texas, California and the business are fine. Some wealthy individuals even create LLCs that own other LLCs, creating additional layers and additional protection. But here's something that will blow your mind. Where you form your LLC matters tremendously. Wyoming and Delaware have become favorites for the wealthy. Why? Wyoming doesn't require you to list member names in public filings, so you stay completely private. Delaware has specialized courts that understand business law better than anywhere else, which means faster outcomes and more predictable results. The cost to set up an LLC? Typically $100 to $500 depending on the state, with annual fees usually running a few $100s. That's nothing compared to what you could lose without protection. Now let's talk about trusts. This is where things get really powerful. But this is also where most people's eyes glaze over. Stay with me, because understanding trusts is like unlocking a cheat code for asset protection. A trust is a legal arrangement where you transfer ownership of assets to the trust, and the trust holds them for certain people called beneficiaries. Three parties are involved. The grantor creates and funds the trust, the trustee manages it, and the beneficiaries ultimately benefit from it. Here's the key insight. Once assets are properly placed in certain trusts, they're no longer your assets legally. They belong to the trust. This creates legal distance between you and the assets, which is incredibly powerful for protection. Let me tell you about irrevocable trust specifically, because this is where serious protection happens. When you put assets into an irrevocable trust, you give up control. You can't change your mind, and you can't take them back. Sounds scary, right? But that's exactly what makes them so protective. Because you don't control those assets anymore, creditors can't get to them. The legal logic is simple. If you don't own it and can't control it, how can someone take it in a lawsuit? They can't. Wealthy families use irrevocable trusts to protect generational wealth. They transfer significant assets into these trusts, name their children as beneficiaries, appoint a trusted third party as trustee, and the assets grow inside the trust, completely shielded from personal liability. Now, there's a specific type that's become incredibly popular, called Domestic Asset Protection Trusts, or DAPTs for short. These are available in about 19 states, with Nevada, Delaware, and South Dakota being the most popular. Here's what makes DAPTs special. You can be both the grantor and a beneficiary, which means you put assets in, you can potentially benefit from them during your lifetime, and you still get significant creditor protection. There are specific rules and waiting periods, but the protection can be substantial. The catch? These need proper setup, and attorney fees run several $1,000s. But if you're protecting 6 or 7 figures in assets, that cost is insignificant. Therefore, trusts aren't just for billionaires, they're for anyone with assets worth protecting. Now let's address the elephant in the room, taxes. Because a huge reason the wealthy structure assets this way is to minimize taxes legally. Let me be crystal clear about something. Tax avoidance is legal and smart. Tax evasion is illegal and stupid. Tax avoidance means using legal structures in the tax code to minimize what you owe. Tax evasion means lying, hiding income, and breaking the law. One gets you a pat on the back from your accountant, and the other gets you a prison sentence. The wealthy are masters of tax avoidance, and they use strategies that are literally written into the tax code by Congress. These aren't loopholes. These are intended features designed to encourage certain behaviors. Let's start with something called S-Corp salary minimization. When you run a business as a sole proprietor, you pay self-employment tax on all your profits. That's 15.3% right off the top for Social Security and Medicare, plus your regular income tax. But when you elect S-Corp status, you can split your income into salary and distributions. You pay self-employment tax only on the salary portion. Distributions just get regular income tax with no self-employment tax. So wealthy business owners pay themselves a reasonable salary and take the rest as distributions. This can save tens of thousands in taxes annually, and it's completely legal. The IRS knows about this and expects it. They just want your salary to be reasonable and defensible. You can't pay yourself $10,000 in salary while taking $500,000 in distributions. That won't fly. But done correctly, this strategy is incredibly powerful. Then there's real estate, which might have the most generous tax treatment of any investment category. Real estate investors can deduct depreciation, which is a non-cash expense that reduces taxable income, even though no money actually left your pocket. But it gets better. Cost segregation allows investors to accelerate depreciation by identifying property components that can be depreciated over shorter timeframes. Instead of depreciating the entire building over 27.5 or 39 years, You depreciate carpeting over 5 years and appliances over 7 years. This creates massive paper losses that offset other income. A real estate investor might show $50,000 in losses on paper, but they're actually cash flowing positive from the property. Those losses can offset their W-2 income, dramatically reducing their tax bill. And here's the kicker. When they eventually sell, they can use a 1031 exchange to defer all capital gains taxes by rolling the proceeds into another property. Done correctly, wealthy real estate investors can defer taxes indefinitely and then use stepped-up basis at death to eliminate the tax liability entirely. This isn't some underground secret. This is precisely how the tax code is designed to work. Congress wants to encourage real estate investment because it creates housing and stimulates the economy. Therefore, they created these incentives specifically for this purpose. Now, you might be thinking, this is all great for billionaires, but what does it mean for me? And that's the right question to ask. Because understanding how the wealthy structure assets isn't about jealousy or complaining about the system. It's about recognizing that many of these strategies are actually available to you too. You don't need $100 million to benefit from an LLC. If you own a rental property or run a side business, an LLC makes sense for you right now. You don't need to be a billionaire to understand S-Corp taxation. If you're making $60,000 or more from self-employment income, S-Corp status could save you serious money every single year. You don't need a trust fund to use trusts. If you've accumulated assets worth protecting and you want to plan for your family's future, trusts become relevant much sooner than you think. The real difference between the wealthy and everyone else isn't access to these strategies, it's knowledge and willingness to invest in proper structuring. Most people will spend $50,000 on a car without thinking twice, but they balk at spending $2,000 on legal structures that could protect everything they own. Here's what you need to understand. The wealthy see legal and tax structuring as infrastructure, not as an expense. It's a foundation that everything else builds on. They spend money on attorneys and accountants, not because they're trying to cheat the system, but because they understand that proper structuring saves multiples of what it costs and provides protection that's literally priceless. The middle class tends to operate on the principle of earn first, protect later. They think they'll wait until they're wealthy to implement these strategies, but that's backwards. The wealthy operate on the principle of structure first, build within the structure. They create the protection before they need it. And here's the really important part. Once you get sued or face a legal judgment, it's too late to protect your assets. Courts will look back at transfers you made and can potentially reverse them if they appear designed to avoid paying a judgment. This is called fraudulent transfer. The time to structure your assets is when the skies are clear, not when the storm is already hitting. That's why wealthy people set up these structures even when there's no immediate threat. They're creating protection in advance, building the fortress before anyone tries to attack it. Look, I'm not here to tell you that the system is fair or that everyone has equal access to these strategies from day one. Clearly, having money makes it easier to protect money. That's just reality. But what I am telling you is that these strategies exist. They're legal. And depending on where you are financially, some of them might be accessible to you right now. The question is, what are you going to do with this knowledge? Are you going to complain about how unfair it is that wealthy people can protect their assets? Or are you going to start thinking about how to implement the aspects of this that apply to your specific situation? If you own a rental property and it's in your personal name, you're taking unnecessary risk. Setting up an LLC might cost you a few $100s and a couple hours of your time. That's not a billionaire strategy. That's just common sense asset protection that's available to anyone. If you're self-employed and making decent money as a sole proprietor, you're probably overpaying on self-employment taxes. Looking into S-Corp election could save you thousands per year. Again, this isn't some exclusive club. This is basic tax optimization that most CPAs can help you implement. The point isn't that you need to replicate everything a billionaire does. The point is that the principles of asset separation, legal protection, and tax optimization scale across wealth levels. You just implement the version that makes sense for your situation. And as you build more wealth, you gradually add more sophisticated structures. You start with an LLC for your rental property. Then maybe you add another LLC when you buy a second property. Eventually, you might implement a trust for estate planning purposes. Years down the line, you might create more complex holding company structures. It's a progression, not an all or nothing decision. But it starts with understanding that wealth protection is part of wealth building, not something you tack on at the end after you've already made it. The wealthy aren't hiding their money because they're trying to break laws or because they're paranoid about the government. They're structuring their assets intelligently because they understand that protection and optimization are fundamental components of building lasting wealth. You can be frustrated by this reality, or you can learn from it and apply what's relevant to your life. That choice is entirely up to you. But now at least you know how it actually works. And that knowledge is worth more than most people realize. Because understanding how the system works is the first step toward making it work for you instead of against you. And that might be the most valuable wealth-building insight of all. If this opened your eyes to how wealth actually works, do me a favor and share this video with someone who needs to hear it. The more people who understand these principles, the more people who can start implementing them in their own lives. And if you want more content that breaks down the real mechanics of building wealth, instead of just surface-level advice, hit that subscribe button, because I'm just getting started, and there's a lot more to uncover.